From the morning reading, stocks rally after consumer confidence hits 96.5 versus a 93.6 estimate in December. All 9 sectors moved higher on Tuesday. XLK, XLV, and XLY were the strongest sectors, while XLU was the weakest sector. Breadth strengthened as advancers led decliners 2.82 to 1 on the New York Stock Exchange and 2.21 to 1 on the NASDAQ. Small options traders have been quite defensive. Last week they spent more of their volume on selling call options than they did on buying calls, which means they were focused on a defensive strategy more than on an offensive one. It was so skewed to the defensive side that it was among the most extreme weeks in a decade, usually seen after a large correction in stocks. So far this year, the average country is up 0.96%, although just 33 countries are up while 43 are down. Jamaica is up with the most at 92.62%, which is more than double the gain of Latvia in second place. Italy has been the top performer for a G7 country with a gain of 13.3%, followed by Germany at 10.28% and France at 9.51%. Canada is the worst performing G7 country with a decline of 9.61%, and the UK is also in the red for the year by minus 4.25%. The US is marginally higher for the year at plus 0.76%. Of the BRIC countries, China is the only one in the green with a gain of 10.17%. Russia is down 2.66%, India is down 5.16%, and Brazil is down 12.31%. 22 of the 76 countries that are down by more than 10%, while 18 are up by more than 10%. Peru and Ukraine are down the most at more than 30%. Overall, there's been quite a bit of performance divergence among country stock markets in 2015. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:43 a.m. Central Time, and I am recording this in preparation for the market day of December the 30th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, it was kind of slightly weak, just below scratch. The S&P futures were down 3 points for 0.14%. Russell futures down the same. NASDAQ down just a scratch amount, and then Dow down about 0.19%. Crude oil, though, down big, down over 2.83%. Euros down about 0.14%. U.S. bonds, the TLT type bonds, are up about 0.16%, and then gold is essentially scratch. In terms of China and other overseas markets, pretty mixed. China up 0.25%, Hong Kong down 0.5%, Japan up about 0.25%. Germany and United Kingdom both down, with Germany at about 0.2% and United Kingdom down about 1.4%. In terms of macroeconomic reports for today in the U.S., you have pending home sales and the regular weekly crude oil inventories. Given how much crude oil has been apparently the market driver on up days and down days of late, that might be more important than it has been in the past outside of the crude oil trader market. So you might want to be aware of that report, and that'll be at 9:30 Central Time, 10:30 Eastern. Of course, tomorrow we have the weekly unemployment report, Chicago PMI, nat gas, and that looks to be about it. Of course, Friday, the markets will be closed in the United States. In terms of market condition, as you would expect, continued pressed down on fear with yesterday's big up action. Short-term VIX down below a 15 now to 14.74. I still have a very elevated skew running, and it's almost a 140, so that continues to be a worry and warning flag. IV percentile though only a 19 for the S&P, 15 for the Russell, 16 for the Nasdaq, and 17 for the Dow. So when you look at the short-term VIX, you look at these IV percentiles, there is no fear being priced into the market to speak of at this time in a relative sense. Now, we did have big price moves yesterday, and a 2 standard deviation move put in by the Nasdaq, 1 standard deviation moves put in by the other 3 indices, and you see this trend continues with these big moves, and indeed I believe this is 7 the last 8 trading sessions, full trading sessions, that we've had at least a 1 standard deviation move on the S&P. Okay, let's take a look at the charts. So, I mentioned yesterday's pre-market that I wouldn't have been surprised to see us move to the top of this kind of tweezer pattern or dark cloud cover pattern, you know, the most recent swing high, or that we would retrace back down to this low, and that we probably would not exceed either one of those extremes before the end of the year. So a little bit surprised that we did not just poke out, but close above that swing pattern yesterday, though not by a lot. We'll see where this goes today. Right now, things seem to be a bit weak. Live action, we're down 5 points at this time on the S&P futures. So it would seem that we're probably going to, we still got a ways to go before the open, but we're probably going to open just a bit weak, is the current bias in the futures market. And we'll see if this just ends up being a little bit of a whiplash and comes right back into this range, or if the action today is able to truly break out of this area and then make a run at this area here. This would probably be the 2100, which is, frankly, if you go all the way back through 2015, the 2100 has essentially been the primary upper end of the range going back for months. Then about 2000 being the lower end of most of the action for 2015, and we've basically just gone back and forth between these two extremes. And in fact, we'll talk more about the IBD confirmed uptrend in just a moment, but we did get another signal from that. Let's finish off the charts here real quick. Here's the Dow, very much like what we had in the SPX, where it surpassed this prior high. Made a pretty good statement there. Now, one thing that has to be noted is volume. The volume on the S&P, I think, was something like 69 million yesterday, whereas the annual average is more like 118 million. So again, kind of suspect when you see these kind of breakouts on such thin volume. And it reminded me of that week prior to the Memorial Day weekend, where we set an all-time high on very low volume, and then as soon as all the market participants were back the following Tuesday, it got crushed. And it makes me wonder if we're not setting up for the same kind of setup here, where we get these new highs on low volume without all the market participants, and then come Tuesday, when we get back from the holidays and all the market participants are back, that they just take it all back, and we don't see those highs anytime soon. So we are up near very significant resistance areas against these markets. So from a pot odds standpoint, unless we get significant bullish participation that does something that has not been able to do all year, there's not a lot of room left to the upside, whereas to the downside, there's significant space. So same thing here on the Russell. We also broke through, the most recent swing high there. It set a new high. So got to keep this all in mind in terms of just where are we most likely to go. In terms of VIX futures and the fear, like I said, we're we're kind of back down here into the bullish market. And, anything below an 18, I always consider something of a bullish amount of fear premium, and we're back in that range. I'd love to see us get down here below 16. We seem to have chattered in recent weeks down to as much as about a 15 and change to 16, but then at that point, more volatility comes back in. We can't quite seem to get, into truly low levels, 12 to 15, that lower range of the bull. It seems to be oscillating into that upper range, but bottom line, we're still below an 18, so that certainly is some significance. Bonds had huge move yesterday, and it makes you wonder if we'll not see something from the bonds kind of telling us where this market's going to go. Let's see if this truly starts to break down one direction or another, or if we just simply, like the broad markets, just kind of poke and then come right back in to the recent trading range once again. In terms of that daily report, well, there are a number of important changes here today. Still have us as phase 2, that trend reversal, but big change here, IBD status change to confirmed uptrend. This is the 12th confirmed uptrend signal for 2015, and as you probably already surmised, that's an average of once a month. Obviously, none of these have lasted very long. None of them have followed through in any kind of significant way for the bulls. It has been that kind of year, and basically you think of 2015 as the year of the range-bound market. Unless something dire or surprising happens in the next day and a half, it would seem that this confirmed uptrend will be just one in a long line of 2015 signals that we'll kind of wonder and question and just see how much action we actually get, how much follow through we actually get. It seems like almost every single time we've seen this range to the top, it has just immediately failed, sometimes with a little bit of poke action and express a new high by a few points, but then just whiplashes right back into the range and goes and visits the other side of the range. GMI index currently a 3 out of 6. It's still on a sell signal since 1210, and that author remains in cash. I should also say the accumulation distribution score for the S&P remains a D- and the NASDAQ at a D. So not terribly promising there for the bulls. Decision point scoreboards have not changed yet. Still relatively poor signals on the short term, and on the long term, the intermediate term continues to be relatively positive. In terms of the intermediate term market posture, we did have significant improvement in this area yesterday, bullish, and a very slightly bullish sentiment line, and indeed you could really almost read that as neutral. It is so flat, and the flatness has been expressed for quite a amount of persistence, that it's really hard to say that it is giving much of a signal one way or another. This intermediate term market posture, though it is scored now as very bullish, and indeed 3 of the 4 indices are now very bullish, I continue to be somewhat suspect of this, because it seems like every time we get a very bullish, we just immediately turn back around and flip over. So we've had, as you've seen with the IBD confirmed uptrend status, a lot of these indicators this year have been subject to frequent flip-flops and changes. It's just been one of those tightly wound markets with nothing really following through to either side. And we talk about the bulls. Well, the bears also haven't followed through. Other than our little visit down for a few trading sessions in August, we essentially have held the lower part of the range all year. And it wasn't long for those folks in August to regain the former range. So it's been not a year for follow-through on bulls or bear side. Hedge warning status has been reduced to a level 1 from yesterday's level 2. This is now yellow light. And indeed, if we had more of a recent history of real follow through, you could argue that this could even be dropped down to a 0 plus, because there just really isn't a lot of other warnings in play right now. So to kind of go back to the top here, we had this GMI index, we had this accumulation distribution scores, we have the decision points that are still with mixed time frames, and we don't like that. We want to see those time frames stack. But many of our other indicators are doing just fine. There's still this elevated skew. There's still this kind of larger than perhaps normal expected move in the next week out. There's only one of the 5 intermarket risk aversion indicators that are currently flagging risk off. Yesterday, we had that huge move, and yet we didn't even get 300 new month highs in the New York Stock Exchange. So again, on top of that relatively mild volume yesterday, it doesn't seem terribly strong for the bulls. From a price action standpoint, you have to give it there. It was big candle, and it broke through a prior swing high and closed above it. That is absolutely one for the bulls. But in terms of broad participation, breadth, we've talked about that earlier this year quite a bit. Breadth would seem to be somewhat suspect in much of this action of the last 2 weeks. Fear and greed index has improved. It's now neutral. In terms of specific option strategy opinions, they're pretty much all in the same place as yesterday. We are inside the acceptable window, but I would suggest continued defensiveness in the way you structure your trades, whether it be option income strategies, cover calls, or put selling, that you maintain a somewhat defensive structure to how you set those up because of this ranging behavior that we continue to see. In terms of sector specific, mostly up. 3 sectors still holding somewhat more neutral, and they have indeed been the ones that usually go red the fastest of late: transportation, energy, and retail. So that's probably the takeaway note, that if we do turn back down, those will be the ones that will be probably hit the most and will lead the way down. In terms of percent change yesterday, you see information technology and healthcare led the way, followed by consumer discretionary, utilities, energy, telecom, all at the low part, but still nicely up for the day. Okay, that should be enough for today. And let's see, in terms of special programming, I did send out emails to everybody on the email distribution list, as well as a number of other invitation areas. I have released the details on this cover call mastery course. I didn't put the website on here yet. I'll put that on here after I close down this video, and I'll have that ready for you tomorrow so that you can get to those details. But everything's come together on that. We have released this to the public now, so registration is starting to enroll. So I'll put more details in for that tomorrow. Just look for that at tomorrow's video, and you'll be able to get signed up for that cover call mastery course. As always, if you find what you're doing with your trading is helped by what you get here in the morning, we certainly love to see those comments and other acknowledgments, and you can certainly do that by liking us on YouTube, retweeting us on Twitter to your Twitter followers, to your StockTwit followers, and then of course you can subscribe to the YouTube channel. That has a couple advantages. You get notice when new content has been published to the channel, and of course the whole thing is free. So when we say subscribe, it's a free subscription, so it's certainly something that you can do there as well. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Full disclosures are at this hyperlink, so feel free to go there if you like to see all the legalese. That should be enough for today. We'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.